Hello, chart watchers, and welcome to this Friday, October 12th, Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, this morning we've got a little bit of a rebound here. Thought we had a rebound. Let me see if I can get that chart back up again. I thought I had it here ready for you. Earlier today, we did see a big gap up in the market, and you can see the Dow Jones Industrial Average is back down off of that earlier gap, but still holding on to some gains, currently up 142 points. The S&P 500 is up 23. The NASDAQ up 109. The Russell 2000 up 6. You can see, actually, Russell 2000 has given up almost all of its gains at this point today. 10-year Treasury yield did gap up earlier, it's pulled back a bit, but is still up 1.5 basis points to about 3.15%. Volatility index down 8% today, but it is beginning to rally again as the market has pulled back. Technology leading to the upside today. That's good news. Actually, yesterday, even though it was down, it was a relative leader. Just wasn't down as much as some of the other areas. So for a second straight day, we're at least seeing some relative strength in technology and also in consumer discretionary stocks. These are the two areas that were clearly leading to the downside. So perhaps a little bit of a positive sign there in their relative performance the past couple of days. Utilities, you can see at this point, has rallied back a bit off of its earlier lows, but it is down today. Along with financials, we're going to talk about this quite a bit this morning. We had 4 major banks coming out with earnings reports today, and financials, after gapping up earlier, are back down near yesterday's lows, and the bank index has actually taken out the lows from yesterday, and this is a pretty big level on the chart, so we'll talk about this in a bit. PNC Financial, the worst performer in the S&P 500. They are one of the 4 banks that reported this morning, and apparently the market not really liking what's going on with these banks, especially with PNC, as you can see, down 5%. And that's after a pretty significant drop the last couple of days, and really over about the last 6 to 7 weeks. The stock was up over 145 back at the end of August, now down at 125. Well, Erin, it is the end of another week, and I tell you what, I am glad this week is just about over.
I know. I think a lot of our viewers feel the same way, unless they've been shorting.
Yeah, there have been a couple of pockets of, we talked about gold a little bit yesterday. There have been a couple of pockets of strength this week, but for the most part, it has been down. So unless you're bearish and playing on the short side, it has not been a good week for the longs.
Yes, exactly. And, I think you alluded to it. Today's bounce, while great, isn't, we need to see some more strength and finish off the day, certainly in positive territory.
Yeah, no doubt about it. And as far as, really taking a look at what's been going on in the markets this week, there's no one better than Mary Ellen McGonagle, and she's joining us again today for What's Hot and What's Not. In just a few minutes. Mary Ellen, how are you doing today?
Oh, I'm doing well. Thank you. Yes, taking a little breath of air today on the relief rally.
I think everybody's breathing a little bit today. Everybody's been holding their breath for about 4 days now.
That's right.
Yeah, I'm a little concerned about the rally attempt today, but we'll talk about that a little bit. I don't know if we're quite done with this selling, but I know you've got some good information to share with us in about 15 minutes or so.
You bet. Yeah, look forward to it.
Awesome. All right, Erin, big day today. Lots going on. Last day of the week. What are we going to do today?
All right, TGIF. I will be doing my workshop next week on big picture indicators. Martin Pring will join us on Wednesday, so mark your calendars. He doesn't come on that often. And Julius de Kempener will be here Thursday. Always interesting to hear more about RRG. All right, today though, like we said, lots of information to cover. Mary Ellen's here for What's Hot, What's Not. Our 10 and 10 first symbol will be Walt Disney Companies. And we'll finish it off with the sentiment update. Really interesting numbers today, seriously. Stick around for that one. But let's go ahead and get started. Technical news and headlines. Back to you, Tom.
All right, sounds good. Let's take a look at those key economic reports out today. Actually, there was just one. So really not a whole lot to talk about here, but at 10 o'clock this morning, October consumer sentiment was released, and it came in at 99 versus 99.5. So a little bit of a disappointment there. But when we take a look at the 10-year Treasury yield, really not a whole lot. We did gap up earlier today, and now pulling back. Let's see here. Actually, Erin, if you could grab that screen for just a second, because I don't think, unless my screen is showing, I don't think it's showing right now.
We're seeing your mountains, so I think you just need to get.
Well, I don't want to hit the stop share. There you go.
I got it right there.
Thank you.
Mm-hmm.
Okay, the 10-year Treasury yield, you can see after gapping up earlier today, that we did pull back. I mean, we got up as high as 317, but we have pulled back now to about 315. Talked about this earlier when we broke out above 311. I wouldn't be surprised to see us come back, test this rising 20-day moving average, and also that double top breakout at 3.11%. So we've done that. We've come back. We haven't gotten all the way back down there, but we certainly have gotten close. But what I find really interesting is that it seemed like when we broke out above 311, all the talk was about how interest rates going higher was the problem with the market, and the market started selling off. And then when we get the 10-year Treasury yield pulling back, we don't get those gains back. So I think it's hard to argue that it's simply Treasury yields going higher that is driving the stock market lower. I don't believe that. And I think if you take a look at the market, we can go back over the last couple of years. Remember where the S&P 500 was 2 years ago, back in latter part of October of 2016. Here's the 10-year Treasury yield. We have gone from 175 or 170 up to 320. And if we pull up the S&P 500, I think you're going to see that the S&P 500 has withstood these rates just fine. So anyone who's trying to convince me that the rates, the 10-year Treasury yield breaking out above 311 and moving to 325 is the cause of this kind of behavior in the stock market, I'm going to be a little skeptical of that. So I would be careful to make that, to jump to that conclusion. Before I get into anything else, though, today, I do want to mention, I've mentioned it in my blog, so I'm going to pull this up to show you from the member dashboard. If you click on the blog articles, you can go to my blog, which is Trading Places. I just wanted to point out the last few days in my blog, I have mentioned that I'll be speaking to the Charlotte chapter of the American Association of Individual Investors tomorrow morning. That is October 13th, and it's going to start at 10 a.m. And if you want information, if you go into this blog article and just click here, it'll give you a little bit more information about the location and so forth. What's interesting is I planned this discussion, I don't know, maybe 3-4 months ago. And of course, we were right in the midst of a really nice bull market. And so the topic was going to be how to evaluate the sustainability of a bull market, taking a look at some relative strength and gap trading strategies and so forth. And then, of course, we have this leading up to my talk. So tomorrow is going to be very interesting to talk about the sustainability of a bull market when you've got this kind of information, but actually, or this kind of selling. But I actually think this is important. It's easy to make the call of a bull market when everything's high and moving up and no volatility in the air. I think trying to evaluate the market now is much more difficult. So I think this discussion tomorrow will be very interesting. And if you are in the Charlotte area and would like to attend, I'm pretty sure that the AAII allows first-time visits at no charge. So you can follow that information. I'm sure there's a number to call if you have any questions, but hopefully you can make it and show up tomorrow. Love to see you. And make sure you stop by and say hello if you do. But let's take a look at a couple of things here in the market. Now, I do want to just mention that if we take a look at a shorter term chart, and I'm going to just look at the 1 month 60-minute chart. So let's take a look at the hourly, and I'll just leave it here on the S&P 500. One of the things that you've got to do in a downtrend is get back through the declining 20-hour EMA. That's like an initial step. And you can see we really struggled with that a few days ago, and then the selling continued, and the S&P 500 has not been able to get even back to test. I mean, I know this morning felt good, but we haven't even gotten a test of that declining 20-hour EMA yet. And you can see how we're back at the low of the day, starting to go lower again. I just don't feel like this is how we're going to see this bottom form. So I think we're going to go back down to test and perhaps set some new lows, and then maybe get some more panic in the market. And it's really going to be that heavy volume, climactic selling where everyone is just throwing the kitchen sink at the market. That's when I think we're going to see a bottom. You can see the Dow Jones, same thing, this 20-hour EMA, not even close to it. Now, we pull up the NASDAQ. We actually did go up and test it earlier. You can see we got in the second hour today, right after 10 o'clock this morning, we were almost right on that 20-day, and you can see how we had tested it once before. The PPO looked really strong, but we couldn't get through the 20-hour, and back down we went, put in a new low on the PPO. Now we can see the PPO strengthening again, but so far not able to get through that 20-hour moving average. So right now, I don't like the way the market is acting after this gap up. It was purely a gap. We're not seeing any concerted buying after the earlier push to the upside, and that is a little bit bothersome. If we pull up the Russell 2000, I know we were getting close to going negative. We are actually up less than 1 point now after being up almost 20 earlier this morning. And again, check out these failures at the declining 20-hour EMA. Just trying to report what's going on here, not trying to scare anybody, but I do think that these bottoms are set with some really heavy selling, climactic type activity with really high readings on the VIX. And now that we've broken up into the 20s on the VIX, it wouldn't take much to get us to 30 or 40. And that's where more significant intermediate term bottoms have formed with the VIX up around that level. So anyway, just wanted to point that out. The bank index, I also wanted to point out because this is one ugly looking chart right now. And if we go back and let's just take a look at the last year, you will see that we are taking out lows from earlier in 2018. This 450 to 455 area has been very important. Right now, we're at 445 and change, clearly below those levels. I don't like it when the banks are performing poorly. To me, that just sets up potentially for more selling in the overall market. And so I think the banks are something we're going to really want to focus on this afternoon to see whether or not we're leaving a tail down below this support level or whether we're physically breaking down. There was a chart that I annotated, so I'm going to bring this up because I think if the market sells off further and we get more panic, one thing that would be very interesting is if I connect those recent highs, this is a 5-year daily chart. I just want you to look at the pattern more than anything else. If we connect the highs that we saw back in 2017 and early in 2018, and then use that same slope to form a channel coming off of these lows back in 2016, potentially we're looking at a 400, a move down to the 400s. And the uptrend that I'm looking at here, when you go higher high, higher low, higher high, this to me is a significant low. Then we go up and put in another high. We haven't gone below this low. So from a longer term perspective, not short term, longer term perspective, I think this 385, 390 area is going to be really important. And if we don't hold this 450 area today on the close and that volatility index picks up again, I think the banks could be in some trouble here, especially after 4 companies came out with some pretty decent results. 3 of the 4 beat on their bottom line, and we're still getting a negative reaction. And that is concerning to me as far as the banks go. All right, Erin, several upgrades, downgrades. What do you got today?
All righty, let's take a peek. Tons of them today, actually. We've only picked out a few of the more interesting ones, I would say. All right, here we go. So we had, I'm going to look at 4 upgrades and 3 downgrades, and they're already ready to go here. All right, so Microsoft I thought was very interesting. I'm going to annotate this. I don't know what happened to my annotations, but we'll add that in here. It's sitting at, I would call, some very important support. It did. It hit it and it's bounced back up. I think that this is a pretty nice opportunity on the upgrade, but I would like to see that PMO really turn up. But you can see it's just about ready to hit the 0 line. It's getting oversold. And, you know, if we can get this market to not continue to fall after a nice bounce, I would look for technology to, you know, start to look a little bit better. But this might be an opportunity here. I just, with most of these, the market is still really volatile. So I know I'm not going to be jumping into anything, but I think the setup is coming together there for Microsoft. All right, for Netflix, I also think the setup is looking pretty good here. The only issue I have is there's a PMO sell signal in it's, you know, already occurred, and now we're getting readings below the 0 line. You can see a little bit of a deceleration of the PMO, but the rest of the indicators don't look that great. I like this bounce off the 200-day EMA, however. 2050 negative crossover puts this in neutral as far as decision point trend models are concerned. Right now, if you look back here, this was some, this could be some interesting support / resistance. Right now, it could be the resistance area. If we get back above, we can get up to that 20-day EMA, I'd feel a lot better about that one. Spotify was upgraded today. Let's see, I want to read you some of what's going on here. So Spotify was upgraded by Pivotal Research Group from a hold to a buy. And investors seem to be pretty happy about this. This is, of course, all the history we have on Spotify. So I stretched it out a little bit. But you can see a really nice bounce off of support from these lows we've had right after the IPO, when we were in a pretty decent trading range here. We're now, we hit the bottom of that range. We're getting the bounce. The PMO is starting to turn up. I think Spotify is looking a bit more healthy, but overall, when I see that 2050 negative crossover, we have a completely negative configuration of the trend models right now. Square was upgraded today by Canaccord Genuity from a hold to a buy. And you're going to notice, of course, based on market action anyway, that we have these very deep corrections. And now today, a lot of these are bouncing. And part of it, I'm sure, has to do with, hearing about the upgrade. But just, I think bargain hunters are out there right now for those quick profits and coming back out. I'm looking at this area over here as possible resistance. I mean, these aren't major tops here, but we're now starting to struggle here. You can see the gap that was formed. Let's actually look in the thumbnail. We see the gap that was formed, and we're just trying to close it. If we close it, I would look for more upside. All right, there were actually a bunch of other big name upgrades. I'll just let you know about. I'm not going to go through the charts because we just don't have time, but Costco, ESV, we talked about, Fitbit, JetBlue, Marvell, RH, Snap, and Twitter. All of those were upgraded today. So really interesting to see such a large group out there. But let's look at the downgrades now. And we can see with Antero Midstream Partners, Barclays downgraded from overweight to equal weight. I see a possible flag here, which is what I annotated. I've got the PMO buy signal that popped in on that big move to the upside. We're clustering right now at about 33. I could see it maybe dip down again to test that 32 area. But I think this one is actually setting up pretty nicely, even for a downgrade. Notice that the EMAs are much more healthy. The PMO is much more healthy. So possible bottom fishing, if you want to call it a bottom feeding opportunity. But when I see that flag, it doesn't have that feel of a bottom fish. All right. Downgrade for Estee Lauder by JP Morgan from overweight to neutral. And as you can see, we've dropped below what I would call some pretty strong support here at these lows we had in May and in August in this support zone. We've now dipped and are trading below this area where we had, I marked these because I saw these earlier consolidation zones. So we're dipping below this particular consolidation zone, and we're now getting ready to enter this particular consolidation zone that we had before. So look for that area of support right about that, 122 level. See if it can hold that. If it cannot, we can go down here as well to where we had that gap, and we haven't closed that gap yet. And if the markets are going to continue to be on the downside, I would not expect this one to improve. And, with the PMO sell signal, not looking that great. And finally, Weatherford International, we had a downgrade today from a buy to a sell. And we're coming down here towards a pretty interesting support level, I would say. Short-term support here. We got a touch back here, a couple touches here. But the PMO has turned over, is now below zero. We're probably going to get a PMO sell signal below the zero line. So I would be looking for a test. I think this one's going to drop pretty far. WFT, Weatherford International. Let's see, a couple other big name downgrades that I'm not going to look at the chart. CMS, Diamond Offshore, DO, Molina Healthcare, we looked at that one in the 10 and 10 yesterday, and Sunoco also downgraded today. That's all I have. Time to bring in Mary Ellen for what's hot and what is not. Are you all ready to show us, well, like we were saying, is there stuff out there that's hot?
Well, it's going to be a whole new definition of hot, but yes, believe it or not, we have seen some pockets of strength out there, and most of it is going to be driven by certainly stories, acquisitions, and defensiveness. So let's go ahead and I can share my screen here.
Yes.
And get things going. See if I can, hopefully we're good here.
Yes.
And super. Okay, yeah, so very, very, very tough week for the bulls out there, certainly. And this, I think, picture tells it all. We're looking here at the weekly sector summary. And even with today's bounce, we can see the hit in some of these areas of the market has been really quite damaging, to say the least. And the first area I wanted to start out with, for those of you that follow the markets super closely, I'm sure you noticed the rally in gold stocks. And we can just take a quick look at GLD, which is the ETF for gold stocks. And you can see this nice big gap up here on that ETF this week. So let's go ahead and drill down. I'll point out to you a couple of stocks within that gold area that have rebounded and had a nice week. And again, they are going to be driven by story, or certainly sound reasons, in addition to that kind of defensive move into gold. And what we're looking at here is AU. This is Anglo Gold. And the company gapped up yesterday. You can see this big move here. And the reason is they came out and they announced a very large gold discovery in one of their locations. And the anticipation is big as far as what it's going to do to their revenue growth. But even aside from that, the company has very big growth prospects. For this year, they're looking at 883% uptick in earnings, and next year 56%. So we can see technically the stock, that yesterday's gap put it up above this 200-day simple moving average. And you can see how these downward trending simple moving averages had been acting as resistance. Now we've had that gap up. Your MACD had that nice positive crossover, black line up through the red, and your RSI positive. So that's one name. Let's take a look at another stock, KL. It's not as widely known. This is a limited partnership, but take a look here at this gap up. And this is another announcement-related gap up. The company, they reached record third quarter production with their gold. So that was big news. It's also has big earnings this year, 54%, next year 25%. And then we'll take a look at one other gold stock, GORO. This is a smaller company, 320 million. Again, technically very sound, breaking up above these key simple moving averages, RSI, trending positively. Your MACD just poised to get up above that net neutral. And this particular company is, I mentioned it's a little smaller. It's more technically sound. There's not a lot in the way of news or earnings numbers, but certainly worth noting. Let's go ahead and move on. We can take a look at other areas. Consumer discretionary before today's open, it was down 9% on the week. Really got hammered. And this is an area that actually started to break down prior to the broader market's breakdown. So if we look at actually that 9% number is a monthly number. So you can see that it's picking up today. We're seeing a little bit of buying in there. But let's take a look at some of the areas within consumer discretionary that really held up well. And I will tell you in particular, they are going to be some of these restaurant stocks. And there's an argument there that these stocks are going to be buffered from any potential tariff any negative impact from tariffs. So here's WING, and I'm going to go ahead and put up a daily. It's going to be a little more telling as far as just how well the stock has held up. You look at this name and you wouldn't know that the broader markets really got hit this week. And this particular company is what they're doing is they're expanding outside of the US. They actually have 122 locations outside of the US. Their profit margins, same store sales, they're seeing a lot of growth and expansion, earnings estimates being revised up. So that's been a very sound company. Let's take a look at another. This company is smaller. It's FRGI, and it's Fiesta Restaurant Group. Take a look at this gap, this reversal here last week, and then it actually held ground this week again, despite a real tough market conditions. And this gap up here, or this potential downturn reversal, came on the heels of Piper Jaffray had an upgrade on October 5th. And this is another company, earnings estimates being revised upward. They're looking at 23% growth this year, 28% next year. And one other name, another smaller one, NDLS. And this is Noodles and Company. Let's see if I can pull the stock up for you here. It's about a $500 million company. It doesn't look quite as robust as the others, but again, we're seeing an attempt to reverse this downtrend. They are due to report earnings in about a week and a half. The company is on track next year. They're looking at 300% as far as earnings growth, and it's another expansion story. We can take a look at one other restaurant stock here, another small regional. This is Potbelly. PBPB. They are primarily located in the Midwest, in that Chicago area, but it's been rather volatile. It's certainly not a stock that would normally catch my eye as one that would be super compelling because of all of this volatility, but just pointing out that it did have a big significant up move on volume this week. This is another analyst upgrade, Maxim upgrade at the stock, and they put a $15 price target on it, and it's certainly getting a lot closer to that now since they went ahead and did that. But the analyst is talking about food cost reductions are helping make it attractive, and a competitor in their area closed all of their locations. So that's another area of strength. Let's go ahead outside of consumer discretionary. Actually, one last name, pardon me, within consumer discretionary, and that is Restoration Hardware. Now, the stock certainly does not look inviting to me quite yet. This is a stock from my work I had on our suggested holdings list, the MEdge report. But once it broke this 50-day, we did remove it. But it's had a couple of up days here. It's up another 2% today. And the reason is the company announced a $700 million share repurchase program. And this is on the heels of an announcement. Management felt that the shares were undervalued, so they're coming in and repurchasing shares. So it's boosting it, but again, not an attractive looking stock quite yet. We still have hurdles as far as overcoming these simple moving averages, and your RSI is not quite positive, and your MACD, while it's poised to have that positive crossover, we're still in negative territory there. And let's take a look and go outside of
Mary,
I'm sorry. Oh my gosh. Yes.
That's okay. I was just going to say, you were talking about consumer discretionary there, and I had a couple questions relating to some of these specialty retailers. I thought it was interesting. I have been watching some of the restaurants, which have held up pretty well, and was just wondering what you thought maybe of some of these top specialty retailers like Advance Auto Parts, AAP, or O'Reilly, ORLY, which literally with all the selling that we've seen in the market, and especially in consumer discretionary, some of these stocks are only 3 to 4% off their highs and in some really nice uptrends. Just wondering what maybe you thought of those two. And yeah, AutoZone would be another one.
Yeah, that's actually a very, very good observation, Tom, because to see stocks of this nature, again, that are holding up well, and I pointed out a couple of others that are withstanding the broader market pressures. And when you see that characteristic and see that take place, generally speaking, those stocks will go on to greater heights once the market pressures are lifted. But I'll tell you, it's not normally these kind of specialty retailers, smaller, that kind of phenom where they withstand broader market pressures, they're not defensive, they go on to become leaders. They tend to be tech and bigger areas, but it is certainly worth noting because that is a characteristic of stocks. Again, if they're able to withstand the pressures, once those market pressures lift, oftentimes they will go on to lead the market. But I wouldn't expect a specialty auto retailer to lead the markets, but it certainly is a bullish characteristic.
Yeah, one other thing that I thought was kind of interesting too is that while these two in particular, O'Reilly and Advanced Auto Parts, as they've pulled back, their overall group, the specialty retailers, have pulled back more, so that on a relative basis versus their peers, both AAP and ORLY have actually broken out to new 52-week highs on a relative basis. So
wow.
You think of strength sometimes that stocks have to go higher, but sometimes it's just a matter of not going down as much as the rest of the of their peers.
Their peers.
Yeah, what those two have done is pretty interesting.
That's a great observation. And you look back here in this May period, anytime you see this type of gap up on huge volume without knowing specifics, but you can bet that that was earnings related. They came out with great numbers, and the company has just probably, analysts are continuing to raise estimates as the stock just keeps going higher. So very, very interesting. Super.
Yeah.
And I can go ahead and just mention briefly that outside of the US, the Brazilian stocks, they popped. And we can take a look at one stock in particular. This is PBR in the energy. And the reason that the Brazilian stocks, actually EWZ would be a better representation of the country, the stock popped following election results. Now, they're not quite at their final elections. These are primary elections. And individuals were pleased with the results as far as who won that election. So we did see a pop. But PBR is actually company specific as well as country. This is Petrobras and Brazilian oil company, and they actually announced a joint venture with Mexico this week. PBR and Murphy, MUR Oil. So the two of them are both were rallying prior to today's move in the broader markets. So let's go ahead and take a look at some of the areas that have not been hot. And certainly I could have covered the entire time I have here today looking at areas that are just not doing well at all. I showed you that view in the beginning as far as the sector, but let's talk about technology stocks, and we can see just how much damage has been done here. This is XLK, the sector, and we can again see, but the interesting thing here is technology is another area that started breaking down prior to the broader markets. And we can just look at a monthly, and that's going to take us to the beginning of this month. And it doesn't look as damaged here, but going into today, it was down 9% for the month. So we are, of course, with that on the lookout for some oversold bounces, but let's take a look at one of the hardest hit areas within technology. And I'm going to point out the software ETF, and IGV is the ticker symbol for that. And a lot of these software stocks before, certainly through the end of September, on average, were up over 41%. A number of the sub-industry groups within software had really enjoyed a very nice rally. So we did start to see a breakdown in these software stocks. And a lot of that looked like profit taking. So the groups that did get hit the hardest were the groups that have done the best year to date. So when people, Tom, I agree with you, you talked about everyone's pointing toward interest rates. And certainly we've known for quite some time that we're on the path for higher rates. I would argue that the initial downside was in fact profit taking when you look at those groups that certainly were and have been the hardest hit. So what we can do from here is take a look at some of the stocks that are potentially on track to see oversold bounces. And it's going to fall in line with what Tom mentioned earlier as far as stocks that have held up the best going into the open today. So NOW would be a good example. This is ServiceNow. And we've seen some volatility certainly in these software stocks, but what I wanted to point out is what we would need to see before these stocks got interesting again. And certainly the RSI is not quite positive yet. We can go down here to the MACD and see that we're not even close to having that positive crossover before the MACD gets positive. But even more important from my work for all of that, we will need to see the stock break back above its 50-day simple moving average. And from there, we can potentially get a little more positive. Let's take a look at another stock that held up well, actually. And again, this is all going to be relative to its peers. You can see that certainly it was not, it did not withstand getting hit. But here again, we are going to be looking for a positive crossover on that RSI as well as the MACD. So we still have work to do. You can see that those of you that are out there looking for these oversold bounces and for that to turn positive, we do still have work to do. You are going to want to see, again, the stock price break back above these simple key moving averages and marry that with positive technical indicators such as the RSI going back up above this dashed line. You want that MACD to turn. So there's definitely, it is going to take time. These breaks that we've seen have happened on huge volume, and we're certainly not out of the woods yet by any means. But I did want to point out to you some of these stocks yesterday that I've shown you so far did bounce yesterday, albeit tepidly, but they did have up days in a down environment. TWLO is another one, Twilio, and again, still not quite out of the woods, and I did want to go ahead and point that out. So as far as what other names within technology that really got hit hard, Square is one. I know Erin said that they did have a today analyst upgrade, but you can see that this stock actually it was down 28% for the week into the open. And one of the big reasons is one of their top executives departed. And that is super big news. This one actually had the stock, Square, had been withstanding the downside pressure in an amazing fashion. But certainly now we are looking at a broken stock, and it will again take a lot in the way of repair. At the very least, you're going to want to see a stabilization in that price and then a reversal up above those simple moving averages. One other area within software, I'm going to show you some of these stocks that really got hit, and these are stocks that do have sound fundamental numbers, but they this is MindBody. They provide software to the to spas and to healthcare retailers, and you can see really just how hard hit this was, down high double digits this week. And another one that we can take a look at is APPF. This is a software company that works with real estate management firms. And this is another one that this is a weekly, and you can see just how much damage has been done. What I'm pointing out to you here are software stocks that are smaller cap. And for those of you that follow the markets closely, you'll know that the Russell has really gotten hit very hard, quite a bit harder than the other indices. So when you marry that, this is the Russell 2000, this really tremendous breakdown, and you marry that with some of these software, because we talked about that, software stocks got hit the hardest. They were the biggest winners. Let's take a look at one last smaller cap software stock. This company works in the medical space, QLYS, big breakdown. So again, when you look at a group and then you marry it with the market cap area that's getting hit the hardest, you'll see a lot of these stocks got damaged. And I'll tell you, these are stocks that I've covered. The fundamentals are still really quite sound. And so I will obviously over time be on the lookout for this kind of reversal where, again, you need it to break back above these key simple moving averages. You're going to want that RSI to trend positively as well as your MACD. So you want to use history, go back to this June period for a number of those small stocks that I mentioned, and you'll see that downtrend reversal. And we certainly are very, very far away from that happening. Let's go ahead and take a look at another area that surprisingly got hit hard this week, and that's the industrial stocks. Going into the open today, the group was down 7%, and it actually had been holding up really well. And a number of defense-related stocks were getting upgrades, looking quite really as if they may be able to withstand the break, but not so. This week they did get hit, and the hardest hit, certainly last week, we saw trucking and airline stocks get hit very, very heavily. And a lot of that, of course, has to do with the price of oil. These companies have the most to lose from higher energy cost. And we can see that the breaks in a lot of these they're not rebounding. This AAL is down another 1% today. And then some other in the defense related area that had been holding up. Let's take a look at Raytheon, RTHN, and this is a company, actually that is not going to get us there, but Raytheon is RTN, and the stock did get hit this week because of an analyst downgrade, and also LMT, Lockheed Martin. This is another one that had been holding up. They're the #1 U.S. defense contractor, and the outlook had been looking fairly promising because of the uptick in the budget for defense. But take a look at this break, and this is another analyst downgrade related. Also, there's a fear, a lot of talk about global economic growth, a slowdown. So these companies not only provide their products to the U.S., but also overseas. So that kind of thing is not going to be good. XLY, we talked about consumer discretionary, and that was an area that had led the markets, and it did certainly get hit. It was down 9.1% into the open today. But what we can take a look at is an area that got hit the hardest, and that's retail internet, Amazon. Let's take a quick look, and it is having a little bit of a bounce today, but Amazon had a bit of a double whammy in the sense that they do have that big consumer space, but they also have a big cloud tech area, so they were double hit, if you will, as a company. But we can take a look. The stock is down. It was down quite a bit more, but on the monthly, down 12%. And we can see on those longer term charts, and let's go ahead back very briefly, because monthly, a lot of you may not use monthly charts that often, but these are charts that institutions I still work with a number of institutions, and they will look at these monthly charts because realistically, despite that 14% hit in Amazon, you can see I put a 6-month simple moving average, and really you just wouldn't think anything happened. This monthly chart is going to wash out a lot of that volatility, and for those of you that are longer term investors, a monthly chart will keep you in these stocks that are getting hit. It's going to give you a little bit more in the way of perspective. So we can do the same thing with Alibaba. Actually, it's not going to be quite as telling, but certainly a lot of the other names that we've looked at. But Alibaba is a stock that Chinese markets are in a bear market, and it's getting doubly hit because it is in that consumer space, but this is on the what's not side, pointing that out to you. And then retail apparel and shoe, that area was down well over 8%. Going into the open today. A lot of those stocks had done really well going in. So again, just talking a little bit about profit taking and such, but let's take a look at some of the stocks, and this bears repeating with Tom. Earlier, we talked about those stocks that have been able to withstand the broader market pressures, and this is TJX, TJ Maxx, and again, if you look at this stock, you really would not know what was going on in the broader markets. This stock has pulled back really in an orderly fashion to its upward trending 50-day simple moving average. I talked about my MEM Edge newsletter, and this is a stock that we have had on our list going back into this gap up here prior to this gap up on earnings, and we've had it on our list for quite some time, and it holds up really well. They're expanding their store count, and they also are in areas within consumer that are being supported as far as these apparel, and also they have home goods stores and so forth. But we can see this really nice orderly pullback to an upward trending 50-day simple moving average. Your RSI is not quite it's not quite positive yet, and we can see that we're not quite there as far as that MACD, but it is one to certainly have on your radar screen, so that when the markets do right themselves and get healthy, this should be an ideal candidate. ROST is another one, a discount retailer, and you can see that it certainly has pulled back, but not with the veracity of some of the other stocks that we've been witnessing, and it is finding support at an upward trending 50-day simple moving average. So realistically, I would say that 50-day simple moving average is going to be what I call your line of demarcation, because those stocks that have broken, and there certainly are many, many that have dropped below that key simple moving average, those stocks are going to have a lot more work to do as far as repairing. It's going to take a lot of back and fill unless they do this type of action where they just have a V-shaped recovery back up above it. But for the most part, when you see those big breaks, you're going to see a lot in the way of back and fill before they turn positive again. So I don't have, as far as I know, that we can certainly go on and on the negative side as far as areas that got hit. But I did want to point out one other stock that has had a big week this week, and it is going to be more speculative, but perhaps worth noting. And it's in that cannabis space, and the ticker symbol is PYX. And this is newer to the cannabis space, if you will, but take a look at this action this week. Again, bearing what's been going on in the broader markets. And this is it's a smaller company. It's about 400 million. And the way that you pronounce it is Pixis. And the stock, for 145 years, the stock was known as Alliance One. It's a very, very old established tobacco company. But what they've done now is they are transforming. They are certainly in the early stages of getting into the cannabis space. And what they've done is they've hired an executive VP out of Dr. Pepper Snapple, who has done a lot in the way of brand expansion. So that's been viewed as quite bullish. But the company did come out. Currently, they have 97% of their revenues that are derived from tobacco, but they did put out some information, certainly a chart, and that they are projecting that in 5 years that they will be, majority of their revenues will come from cannabis. But certainly it's speculative, it is volatile, but a stock that I thought would be worth noting as far as positive for the week. And then one other area that I didn't really get to is the concept of using what are called bearish ETFs. When you see the broader markets, you want to have, at least if you're not into options, you want to have ways that you can potentially defend your portfolio. So we can take a look at a couple of those before I hand the reins back over. This is EUM. It's a ProShares short emerging markets. So the what you are doing here in essence is shorting the MSCI. You can see how that really has worked for those as a way to hedge a broader market that's going down. EDZ is another one. This is emerging markets bear 3 times. These are going to be a little more volatile, so you're going to have to really zone in and not just buy and look the other way, but they are examples and ideas for those of you that are looking for ways. YANG, this is China bear 3 times, and LABD is one last one that we can take a look at. And certainly This is the biotech bear. So we can take a look at really how well this has done, and you can look for any industry group really, and there are those bear market. This is a look of actually the biotech ETF, and we can see that biotechs really have gotten hit hard. So you can counterbalance that with a ETF such as LABD, which again is short, but it is 3 times. So again, you certainly, if you embrace that, you will want to really key in and actively stay on top of that. So
very good. Very good. I got a question for you though.
Sure.
You know, you were looking at that PYX, which is that marijuana stock that's been
yes
in the news, and you know, there's been all kinds of hype, and you know, of course, the stock when a stock's being hyped up, you know, it brings a lot of risk in. I mean, and, you know, it certainly could go higher, but you got to understand there's a lot of downside as well. I was looking at one that I thought maybe you could, you know, see what you thought of. It's been weak of late, but it seems to be at a pretty good support area, and that is CRON, which is Kronos Group.
You bet.
This is one that back in August and September looked a little bit like PYX in terms of just going up on massive volume. But over the past month or so, it's pulled back quite a bit, and it's back down to that 910 area where we've seen a lot of buyers step up over the past 6 weeks. I was just wondering, you know, do you like to take a look at a stock like this as it gets back?
Yeah. Actually, Tom, that's a great example because it's in line with those other stocks that I was talking about earlier. Certainly not in line fundamentally, but TJX, we talked about pulling back. Now, this did undercut that 50-day, but it does look poised. If we see a cross up, and then also we talked about marrying it with that RSI turning positive, as well as we still have a little bit of work. You want to see that MACD cross positively, but we could see a pickup here. And this would be a wonderful area to put it on your watch list because it appears to just be kind of digesting this downtrend here. It's stabilized, it's back in fill, so we could be forming a little bit of a base here. And this action here, you always want to, it's helpful to go back historically, but this is what you want to see. You want to see this break back above these moving averages, any kind of volume pickup. The nice thing here about this consolidation period is we are seeing a dry up in the volume. So if it breaks back up on any kind of volume and you can marry it with those technical indicators, you could indeed see another updraft here.
All right. One final question before we let you go.
Sure.
And that is, you know, I know we've got a lot of listeners who've been waiting for something like this, a pullback, a correction, you know, get involved in the market. So if you've been waiting and you've got money sitting on the sidelines, would you be using this weakness now to jump in? Or do you think we have time, you know, where we can wait a little bit longer?
Yeah, that's a great question. Well, we've been going over some stocks. A lot of damage has been done, and that is not going to be repaired overnight. It is going to take time. And, you know, whether it's a week or more, it could take us into next month. But I would argue that it's too soon. Yeah, we're going to need to see more in the way of stabilization as far as back and fill, at least a stop to the downside before we can get out of the woods here.
Yeah, I think that's very well said. I know earlier I was, you know, before we even started on the air, I was not feeling very good about the market today, and we've already seen now the Dow Jones go red. Russell 2000 really having a rough day, down almost 1% now. So it seems to be just kind of free falling in small.
Yeah, and I've talked about this in my newsletter that small cap stocks, they are going to tend to lead on the downside. Pullbacks, corrections, that's the index you want to key in on.
Awesome. Well, we appreciate you coming on here. I know that's a lot of work you do to get ready for this half-hour presentation each Friday. It brings everybody up to date on a lot of areas. So really appreciate it, Mary Ellen.
Oh, super. Thank you.
All right. Have a good weekend.
You too.
All right, Erin, it is time to move on. We got the 10 in 10. Are you ready to go?
Oh, you know I am.
Okay, cool.
Are you ready to go?
Well, now that we're hurricane free, yes, I'm ready.
Yes, feeling better. All right, so here are our requests today. I just wanted to point out lots of technology requests. It's always interesting to see where the interest lies among our viewers. I think it's a sort of a little straw poll. as to, what sectors might be getting ready to gain some strength. So technology was the big one. That was what I really wanted to note there. A few outliers here on the RRG. Prefer not to pick any going in the southwest direction. I also do not pick stock symbols that have been looked at within the last week. So I will turn in some that are going southwest, but not always. So I just wanted to give everybody a little bit of an idea of how I pick what we look at, and keep liking in the chat room, and the most popular will be next. So let's go ahead.
All right, we're going to start with Walt Disney.
Yep.
And here is the chart, and nice uptrend. I've said before, I really like Disney. It has been pulling back. I mean, when the market's selling off like it has this week, even the best stocks tend to struggle. And I think Disney certainly qualified as one of the better stocks. We've had a nice rally since back at the beginning of June, where the stock was under 100, went up almost to 120. Pretty nice percent, close to 20% over a few months. But with the selling this week, you can see we're pulling back on this weekly chart. We've been holding each of the last 2 times we've pulled back to the rising 20-week moving average. We have held with a strengthening PPO. So I like the way the chart sets up. I think a lot of what goes on here with Walt Disney is just going to depend on what we're seeing with the overall market. I mean, if fear and panic continue to build, then Disney and many of these stocks are not going to be immune. But on a rally, I expect Disney to be one of the leaders. So really, for me, it's just trying to evaluate the overall market. Right now, I'm a little bit nervous about the market with the selling that we've had and what could be a rough Friday afternoon. We'll have to wait and see. But yeah, I like Disney. I just think if you're going to trade it here, just watch that 20-week moving average. If we go below that, I think I'd get out and then simply wait to see if we can get another reentry at some point. I do think when the market bounces, though, I look for Disney to lead.
All righty. The most popular symbol in the chat room today is Roku.
Yeah, actually, Roku is really interesting. This is one that I like. I just need to be comfortable about the market, because many of these higher growth companies that have done so well, you all talked about Square earlier. You get into those companies, the software companies, financial administration companies, and stocks like Roku. It just simply needs a rest. I mean, the stock was down at 32 back in May. It went up to 77.5 before pulling back recently. What I would do is simply watch, at this point, the overall market. If I feel good about a big reversal in the market, and especially if I got Roku somewhere down in this range around 51, 52, 53, and I feel good about the market reversing, I really like the reward to risk there. Because that, to me, is a major support area. You can see the massive volume that came in with its earnings report back in the second week of August. So I suspect this area is going to hold. But again, it comes down to the market. I mean, individual stocks do some crazy things when the market's panicked. And so we can throw out all technicals. So let's try to get a bottom in the market. But I do like Roku going forward again as one of the leaders.
All right. The next one I have for you is Discovery from XLC sector, Communication Services.
All right, let's take a look. DISCA, I'm assuming. Yeah, the breakout came on really nice volume back in September. And if looking at a stock that's really performed well, given what's taken place overall in the market, I think you'd certainly have to include Discovery in that list. There's your breakout. Here is your heavy volume to confirm that breakout. We are below the 20. I think we have a shot to head back, test the 50-day moving average and that support area just below 30. But this has been a really strong relative performer. So I'd have to include it as one that I'd be more bullish about. I like it.
All right. The next one I have is in the technology area, Trade Desk, TTD.
All right, another one that's been a big leader, but like Square, like Roku, I mean, this stock has made a huge move to the upside, and it's simply pulling back to some key areas. Again, I'm more concerned about the overall market than I am this particular stock. And I think there is your gap support that I would be watching. This was also earnings related, very heavy volume. We gapped up to about 115, took off from there, went to 160. And now here in just, 2 weeks, a little more than 2 weeks, we've fallen almost all the way back down to this key support area. If we close below about 110, 111, and take out that little intraday low right about there, then I think you've got more room, perhaps another $10, $15 to the downside. So, all these come with a lot of risk when the VIX is as high as it is right now. But clearly, the stock is a better choice from a reward to risk standpoint now than it was when the stock was at 160. It has sold off. You can see the overbought conditions are no longer a problem. So I like the stock. I just need, again, to kind of get more comfortable with the market.
All right. We've been talking a lot about gold. Let's look at Seabridge Gold, gold miner, SA.
Nice breakout. And, I did talk yesterday about the gold, the GLD breaking out, and at least in the short term being much more bullish with that breakout after the recent consolidation. So we are seeing some gold stocks performing well. Mary Ellen mentioned it a little bit ago as well. But this is what I want to look for. I want to see this move up, this flag, and then the breakout on heavy volume. I think this is a very bullish pattern. I would like to get it on a pullback if I can to test this breakout level, maybe down around 1335. So if we get a pullback one day, that's where I would look maybe from a reward to risk perspective to get in. But I think the chart here looks really bullish right now.
Okie doke. How about Constellation Brands, STZ, Distillers and Vintners?
Yeah, I remember looking at this chart. I think it might have been on the distillers recently, and I don't remember. I'm going to stretch this out and just take a look a little bit longer. I don't remember what I was thinking about that group at the time, but I mean, we're clearly in Constellation Brands. We are consolidating. We have been consolidating for a while in about a $30, $35 range. And so over the course of the last year, you can see that the important low that was set back in August was just around 200, maybe 199. And then you've got a pretty important resistance area around 233. So currently we're at 222 and change. We got quite a bit of room really to both sides. I think, short term, I could make an argument maybe for the bottom of this gap support down here around 210, 210.50 as a key area. But still, it's hard to set up this trade, I think, on a reward to risk basis. So I probably wouldn't do anything with it at this point. I do like that recent gap up, though. Maybe if we pull back to gap support, might provide an opportunity.
All right. Let's look at a semiconductor. Avgo, Broadcom, AVGO.
All right, AVGO. All right. Well, we've pulled back to the 50 and also to this after moving up on some increasing volume. We did pull back to about where that prior high was, and we held. So I'm going to say 225. I mean, overall, we got a downtrending stock. It really didn't participate to the upside when the overall market was moving higher. So this is kind of a stock that I would keep a short and tight leash on. So I think you can look across here and see really, we could probably put a couple of levels in here. But I'm going to say 220 to 225 was major support on the way down. It also is key resistance on the way up. And you can see our gap sits right in there as well. So this is one that I'd be okay with as long as we hold this 220, 225 area. But again, given the dynamics of the market right now, if we lose support down around 220, I wouldn't be making any excuses for it.
All right. The next one is from the exploration and production industry, EOG Resources.
Yeah, this one, along with that whole group, was looking really good until about 3 days ago. And EOG was making a breakout. Volume could have been a little bit better for sure on that push to the upside. But after putting in a bearish engulfing candle, or at least that big red candle there, that is a false breakout. And so now I think you got to look down to the recent lows as your support here. The most recent high there around 132.50. We need to see a breakout above that. To the downside, I think it's pretty clear we have had very, very solid support over the last 4 or 5 months at about 113.5. So I think we're just in this range and we're sitting in the middle of it now. I like it the closer we get to support because your reward to risk is so much stronger. Sitting in the middle of the range, I don't think I would trade it here.
All right. I think this one has a very interesting chart, biotech, and that would be Incyte, INCY. Pretty important support.
Yeah, I'm not liking it because of the overall downtrend, and I'm going to pull this one up on a relative chart. I think you'll see that it's a very significant underperformer. Here's the biotechs going sideways. Here's Insight coming down, and look at the relative chart. So if you're looking at a biotech, this is really the opposite of what I would look for. I don't want a company that's underperforming its peers and a company that's underperforming the S&P 500 in a group that really is just languishing right now. I don't think that's the recipe to make money. So I would not be interested. I do see the support that you're looking at there, Erin, and I agree. I think if I was going to take a shot, I think that is where I would probably consider taking a shot. The big problem when you're downtrending is a lot of times there's never just one cockroach in the kitchen. And you can see the big gap down and very heavy volume back in April. I would be worried about news overnight, something, because why is everyone throwing this stock to the side?
Right.
I don't know, but I'd be worried about a gap down. I don't like these kinds of stocks, so I would avoid it.
Yep, I have to agree. The 50-day EMA is so far below the 200. I know I wouldn't be involved in it, but very interesting if you want to do that sort of trading range sort of thing. Financial administration, Cardtronic, CATM is our final symbol.
All right. It is an interesting area of support. I like the volume trends here. Let me stretch this one out a year just to see if there's any other key levels that I'm missing from the 6-month chart. We got a nice uptrend in play, got gap support just above 28. I think the two key areas on here are going to be, first of all, that gap support. I really think that needs to hold eventually because of the volume that came in, huge volume on that gap up. And then that prior high, which was here back in May around 32, you can see that's where we seem to be getting some buyers here. So I just think from a bigger picture perspective, the 29 or 28.75 area up to about 31.5, this is your key zone for support. And I'd like to see that hold. I think given everything that's going on in the market, especially with small caps, I think the stock is holding up really well. So I do think that's positive, but I still want to hold on to these support levels. So I like the stock, not really liking the market, and that kind of is a theme for me right now.
I have to agree with you. All right, that concludes the 10 and 10. Here are the symbols that we just looked at. I will have these up, those charts with those annotations, in the Market Watchers Live chart list, and you'll find that at the top of the Market Watchers Live blog page. So go to the blogs tab and find Market Watchers Live, and there you are. All right, time for our final market update. Let's see what has been going on in the market. All right. Well, we did get that pullback, Tom, but it looks like we're getting a little bit of a bounce off of yesterday's close. Just stay in positive territory right now for the Dow, S&P 500. You can see the OEX, S&P 100, very similar situation. The NASDAQ, however, has stayed in positive territory with a big gap up. It has pulled back, but like the other major indexes, it looks like, well, it's been the last 10 minutes or so, we're getting a bit of a bounce. S&P 400 and Russell 2000, they have dipped into negative territory, but are also trying to make a little bit of a bounce right now. TSX, Canadian markets, mostly unchanged, but up slightly at we're seeing a little bit of a move similar to what we have obviously in the US markets with the big open to the upside and a pullback. We've got the treasury yields also moved up a little bit, but off of their intraday highs. We've got 3.142% reading there. We're seeing interesting movement here with the dollar. We have a big gap up and it is pulling back slightly to that gap support at this point. Gold is lower on the day, but not quite as low as I might have expected given that big gap up on the dollar. So I think even though we are in negative territory for GLD, not a horrible place to be right now. TLT is down slightly, reading 114.77, and USO is up 6 cents at 15.01. And that concludes our final market update. I'm going to pass it back to you, Tom.
Okay, just want to point out something really quick, and that is on the transports. We did have a false breakout just recently. This is a weekly chart, 5-year weekly chart. We did get that breakout above the January high, which was bullish, but we couldn't hold it. We couldn't sustain it. We've since lost the rising 20-week moving average and the 50-week moving average. I'm watching these lows down here on the transports. I think if we fail to hold this support area and that weekly PPO, which has been in positive territory for the most part over the past 2.5 years, that would be a negative for me. So I'm going to be watching this 10,000 area pretty closely on the transports.
All righty. Let's go ahead and get started with some decision point sentiment charts. All right. So today for the sentiment update, I think you're going to find it very interesting. And it does obviously reflect what we have been seeing this week as far as bearish sentiment goes, as with the market participants. Remember, sentiment is a contrarian indicator. So for example, when all of the polls are showing very bullish readings, that is actually bearish for the market. So we want to actually see very bearish participants, because when we see bearish participants, that generally means we're looking for a price reversal. So I'm going to be going over these particular sentiment charts, including the VIX, which I know there's a lot of interest in. I'll finish with gold sentiment. I know a few people were interested in the chat room about gold and its prospects for the future. All right, so we're going to start with the put-call ratio chart. I have inverted the scales so that I can use it for oversold and overbought analysis, because like I said, sentiment is contrarian. So using an inverted scale very much helps with trying to determine, which, whether we're oversold and should look for an upside move versus overbought, where we have a lot of bullish sentiment. So that's why I've reversed the scales. Right now, as you can see, we have been moving downward, and we're getting to near term, I would say, oversold territory, typical oversold territory, at least since we've started this major rally back in November of 2016. So we are at a point where we could see a bottom in these ratios. We're not seeing it yet, meaning that we have bearish participants here. And there's a likelihood we could see them move a little bit more bearish. But we are in a situation right now where we could see a reversal. We could get that bottom anytime on the put-call ratio, but not seeing it just yet. Notice the change in the bearish sentiment and bullish readings. So I thought this chart was very interesting. This is American Association of Individual Investors poll, AAII.org, and you can go take the poll yourself. But polling the investors out there, you can see a large increase from bullish or bearish readings we saw before. We're expanding those, and we're seeing a contraction on the bullish readings. So we're seeing market participants getting more bearish. Notice last week on this chart, we had very high bullish activity. Notice, look at the ratio. It was almost to a 2-to-1 setup. And that, like I was saying last week, is very bearish for the market when you go in with sentiment that bullish. And sure enough, I mean, this week, clearly we've seen that downside. Of course, it doesn't always work that way, but I think this is a good example. All right. Moving on through. All right, we're going to look at the name exposure index. This is the National Association of Active Investment Managers. This tells you where the money is. It tells you how exposed they are to the market, how concerned or bullish or bearish are they. And what I wanted to point out is notice this huge pullback on exposure for this week. That tells you that participants, that the money managers are bearish right now. They pulled back what they generally have out on the table and have had out on the table. I mean, look at these readings that we've had through the second and third quarter here. Very high exposure readings. And now we pulled way back to a reading like we saw earlier it looks like at the early part of the second quarter. Typically, when you get these lows, that's when you look for the market to turn back up. you know, I think that that's a good thing to look for. My concern is at this point, we've had, you can see back here in early 2016, mid-year 2015, we had readings that were very low as far as exposure goes, and we're not really that low at this point. But we are low for what we've seen in the past year and a half to 2 years. So I think this is still good news for the market. My concern is that, you know, a lot of times these folks are on it, and we might end up seeing another week on the downside before we start to see that upturn. But overall, seeing the bearish sentiment coming in on name, I think is positive for the market. I think that it is a sign that we could see a upside reversal. Look at where the money has been going. This is the RIDEX asset ratio chart. Guggenheim has a basket of funds that we track, that they give us the amount of assets in every night. We record how many assets are in the bear funds, how many assets are in the money market funds, and how many assets are in the bull and sector funds. And by analyzing this, we can actually see where money is going as far as the market participants, obviously on a small scale. But I think it gives us a really good look. You know, usually the money where your mouth is, that's what this particular chart tells us. And right now, when I look at this chart, people are putting their money where their mouth is. The participants are very bearish right now, and the money is following that. A few things to point out. Big increase in bear funds assets. A lot of movement to the upside there. We're seeing a trending lower of money markets. So you're losing the neutral people to likely into those bear funds. So we're starting to see especially bearish activity, in my opinion. Normally you'll see sort of a flat look here, maybe an increase like we had back here in early September, but typically you get a mostly flat reading on these money market funds. So to see them starting to drift lower, I think really tells you the bearishness of participants in these funds. Bull funds, bull and sector funds, well, we're seeing those in a downtrend. So that is telling you money is leaving, you know, the bullish funds that our participants, like I said, are not interested in being in equities right now, or in ETFs or mutual funds that track to them. Everybody seems to want to be on the bearish side. And what has this done for our RIDEX ratio? Well, you know, as of late, since May, I've noticed that we've been in this sort of a range for our RIDEX ratio. And we are in some areas here where we have, like I noted, a lot of bearish activity. And that is what's bringing the ratio lower. So, I'm sorry, higher. Remember, this is bear assets over bull assets. Denominator getting bigger than this, that means that you're starting to look at lower readings. And of course, when the numerator gets higher than the denominator, that is going to give you higher readings. So what I'm seeing is a ratio right now that is in oversold territory as far as this chart is concerned. And typically when we get into that oversold area on the RIDEX ratio, that's when you start to look for, again, a turn to the upside. So we'll be watching this one closely. It is suggesting that we have especially bearish market participants right now, and that typically leads to a reversal to the upside. All right, wanted to look at the VIX. Lots of concern there because we've had quite volatile readings on it. And I just wanted to point out how I like to use the VIX for sentiment in the very short term. You know, typically when I get on the inverted scale, when I get these oversold or high readings on the VIX, that's when I start to look for that short-term upside reversal. Sometimes it lasts a day or two. Like we saw here, we got a day of upside, but then we fell back down. Followed through with a rally, though, which was nice. So I'm watching to see what we're doing here. Obviously, we're in territory we haven't seen for quite some time this past year for the VIX. And it's still trading, well, it's still outside of its lower Bollinger Band here. This suggests to me that we still have some short-term upside potential here, but I would call it very short-term. Now you can see that this chart works pretty well as far as these downside penetrations of this Bollinger Band, but my concern is that we're in a position like we were back here, and we were back here, where we spent a lot of time beneath the moving average and even outside of that Bollinger Band, and really ended up getting a lot of choppiness. We didn't end up with a lot of downside, you'll notice, but we ended up with a lot of choppiness before it sort of figured out that it was time to start to move on the way back up. All right, and then you can see back in February, a similar circumstance, you know, so while I look at these readings as a good thing when we see them penetrate the lower Bollinger Band, what I would suggest and what I see, and Tom, you've mentioned it, so when we get to really high readings, that just, you know, you're kind of, it's a thin ice is what I would say as far as the indicator goes for short-term analysis. Like I'm using here for the bounces. It's thin ice. Typically, they do lead to a rally or a move to the upside. Typically, they do. But when we get these very high readings and a lot of nervousness and a lot of confusion, it takes a little more time to work that out, to get some move to the upside. So right now, I still think this is positive for the market. And looking at all of that bearishness on the polls, on the assets, you know, I think all of this is lining up so that we could get a, you know, reactionary bounce. The question will be, of course, whether it can turn into the resumption of the rally that we've seen, you know, through the past year. I don't know. We'll have to watch, of course. If we knew right off, we'd all be doing quite well. I think Arthur said that we'd be somewhere where it was, the sun was shining and there was sand beneath our toes. So I just wanted to point out, though, that there is a setup here based on sentiment that we will get a reversal here. I don't think it tells us how long it will last, of course. All right, I wanted to touch on the gold. We wanted to touch on the gold to see what's going on with gold sentiment. And so I'll direct you to the top of this chart. We track the premium and discount for the Sprott Physical Gold Trust. I know there's articles by Carl and I, if you go look them up in Chart School, that'll give you a better understanding of how these are calculated. But the main thing I want you to note is that the discounts are have been really high. Certainly have been trailing up higher and higher as we've moved through this decline that started back in June. Well, we're finally starting to see, you know, some potential here for gold. The setup looked great. Look back here in August, we had really high readings, high discounts, and we had a PMO turning up. Everything was looking pretty good. We got the rally, but we stalled out, and the PMO continued to rise. And is continuing to rise, but we just hadn't gotten any action. It kind of reminds me of when we were waiting for the dollar to break out many months ago. It was like, come on, everything is set up right. Everything looks great. Come on, let's get moving. Well, I think we're finally seeing that in gold. We got a nice breakout, and the discount rates are still high. We're pulling back today. But notice that we're sitting, at least for GLD, we're sitting above that trading range that we've been in. Look at that scooter, the move that it made on that rally yesterday. So I'm looking at this as a possible move to the upside for gold. I think it will continue higher. And, you know, I'm looking at that 200-day EMA as a possible overhead resistance, that 118 level. Now, somebody had asked in the chat room about whether this is just a sign of, you know, the market decline we just are getting, the blip on the radar, or is this the beginning of something a little bit bigger? I suspect it's the start of something a little bit bigger, not a huge giant rally, but I think it is enough to see gold rise up to that 200-day EMA. All right, so that concludes what we had today. So here is the sentiment update summary for you. We have the put call ratio bullish for the market. AAII bull bear ratio is neutral, but the expansion of bears is bullish for the market. NAME had that major pullback in exposure. That means our participants are very bearish, and that's bullish for the market. Let's see, what else do we have here? We have the RIDEX ratio, and it's very bullish for the market based on where the funds are going. And the breadth and the VIX are also at climactic highs. We're getting those Bollinger Band breaks. That is short-term bullish. I'm not so certain, like I said, with the VIX readings so high, I think we are still vulnerable for, big moves down. And that's why I think the intermediate term is still a little iffy when I look at the VIX. Gold sentiment, as I said, very bearish. It's bullish for prices, and we're finally seeing it break out. So really my conclusion is that, obviously we've got a lot of bears in there. The VIX is spiking. Everything is pointing bullish for the market and bullish for gold. So I have to say, I'm going to go in. We'll talk about that poll shortly. Go in and take it to see what you're thinking about next week. I'll just give you a quick hint. I'm neutral because I still think we're vulnerable to a swing to the downside right now with that VIX being so high. And that concludes the Decision Point Sentiment Update.
Yeah, I wanted just to remind everyone before we wrap up today that I will be speaking to the AAII. That was actually part of your
yes.
As the AAII, but I will be speaking to the group. It's the Association of Individual Investors. And in my blog article, if you're not familiar, you can just go into the blog articles, go down to Trading Places, which is my blog. And the last 3 days, I've put in here just a quick note and a reminder. You can click here to get more information, but there will be I'll be talking for about 2 hours tomorrow in just outside Charlotte. And the first meeting is free to non-members. Just wanted to point out, let everybody know. But it's going to be very interesting because I am talking about the sustainability of a bull market. And with what we've seen so far in October, this is going to be an interesting presentation, to say the least. But
I'm sure it will.
yeah, let's go ahead and pull up the poll. I will say this, and I said basically the same thing last Friday, that when the VIX is on the rise like it is right now, it's very, we don't really trade based on technicals. We trade on emotion, which is very difficult to try to predict when enough is enough in terms of selling. I would just say that if the market sells off today and the VIX is on the rise, I'd be looking for more weakness to open up next week.
Yeah.
So I need to see a big reversal. And we have been closing very weak throughout this week, especially the last couple of days. So one sign would be to actually strengthen into the close, but I need to see that first.
Right. And I know everybody's probably thinking, well, wait, all of that stuff was bearish. Why aren't you going into next week as saying higher? And like I caveated it before, with that VIX so high, like we've been talking about, I think we are vulnerable to some heavy downswings. So I think it's just going to be a really choppy week is my sense.
Yep, I would agree. I think that early part, I actually look for by the end of next week, some point next week, if not this afternoon, I do think we'll get a nice rally. But I don't know if it'll last because we are coming up on a very bearish historical week that we can talk about next week. But anyway, thanks everybody for stopping by today and joining us. Please remember to complete the survey as you exit. We do love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe, and we will see you back here on Monday. Happy trading.